If you've ever wondered why some people invest for decades and still end up broke while others quietly build fortunes, it often comes down to the mistakes they avoid. Wealth isn't always about making the highest returns. It's about avoiding the pitfalls that drain your money, confidence, and opportunities. So let's talk about 9 investing mistakes that can literally keep you poor forever. The first mistake is chasing quick money instead of focusing on long-term wealth. Most people fall into the trap of hot stock tips, get-rich-quick schemes, or speculative bets that promise overnight riches. The problem is that these plays are built on hype, not fundamentals. Sure, you might win once or twice, but over time, it's like gambling at a casino. The house always wins. The wealthy focus on consistent, boring strategies that compound year after year. They're not trying to double their money overnight. They're trying to double it every decade with minimal risk. That's how real fortunes are built. The second mistake is failing to diversify. You've probably heard the saying, don't put all your eggs in one basket, yet so many investors throw all their money into one stock, one sector, or even one form of investment like real estate or crypto. When that single asset goes down, so does their entire net worth. Diversification doesn't mean you can't take risks. It just means spreading them out. A balanced portfolio protects you when markets swing and keeps you in the game long enough for compounding to work its magic. Third, investors often ignore the silent wealth killers, fees, taxes, and hidden costs. That tiny 1% annual fee on your mutual fund may not sound like much, but over 30 years, it can slash your returns by hundreds of thousands of dollars. Same with trading fees, high management costs, or selling investments too soon and triggering taxes. Smart investors know that avoiding unnecessary costs is just as important as making money. In fact, sometimes the best investment decision you can make is simply reducing expenses. And finally, the fourth mistake, letting fear and emotions control your investments. Think about it. Every market crash, every dip, every scary headline pushes people to sell at the worst possible time. Then, when the market rebounds, they miss out on the upside. Emotional investors buy high when greed takes over and sell low when panic sets in. The wealthy, they stay calm, stick to their plan, and keep investing no matter what. That discipline is what separates successful investors from everyone else. At the end of the day, avoiding these mistakes is more powerful than chasing the next big win. If you stop gambling on quick money, diversify your portfolio, watch out for hidden costs, and take emotions out of the equation, you'll already be ahead of most people. And once you learn to avoid the other 5 mistakes we didn't even cover yet, you'll realize that becoming wealthy isn't about luck. It's about consistency, patience, and discipline. Because in investing, the secret isn't just knowing what to do. The real secret is knowing what not to do. ChatGPT said, when most people start investing, they're driven by one powerful force, the desire to get rich quickly. It's tempting, right? You see stories of someone buying a stock, a cryptocurrency, or a piece of real estate that skyrocketed overnight, and suddenly you think, why not me? The problem with this mindset is that it shifts your focus from building wealth to chasing luck, and luck by definition is unpredictable. The reality is that chasing quick money often leads you into high-risk speculative plays that look exciting in the short term, but destroy your chances of creating long-term financial stability. Think of it this way. If you're constantly running after the next hot stock or crypto, you're essentially gambling with your future. The stock market does reward patience and discipline, but it punishes impatience. Buying into hype-driven assets might give you a temporary win, but statistically, most people lose far more than they gain. The reason is simple. When something looks like an easy path to riches, by the time you hear about it, the insiders and early adopters have already made their profits. You're left holding the bag when the bubble bursts. On the other hand, real wealth isn't built in weeks or even months. It's built in decades. The most successful investors rely on the power of compounding, where small, consistent gains snowball into massive results over time. Take a simple example. If you invest $500 a month at an average 8% annual return, in 30 years, you'll have over $750,000. That's not flashy, and it won't impress anyone at a dinner party tomorrow, but it's guaranteed to make you wealthier than almost every person chasing quick wins. Another issue with chasing quick money is that it often leads to emotional decisions. You buy when prices are soaring because of FOMO, and you sell in panic when they crash. This cycle of buying high and selling low is the exact opposite of what builds wealth. Long-term investors, by contrast, ignore the noise. They buy quality assets, hold them for years, and let time do the heavy lifting. So if you want to avoid staying poor forever, the first rule is simple. Stop looking for shortcuts. Shift your mindset from how fast can I get rich to how reliably can I build wealth over time. When you focus on patience, discipline, and compounding instead of chasing hype, you'll put yourself in the small minority of people who actually achieve financial freedom. One of the biggest mistakes investors make is putting all their money in one place, convinced that a single asset or stock will carry them to financial freedom. It sounds simple. Find that one winner, go all in, and ride it to riches. But reality doesn't work that way. Markets are unpredictable, companies fail, industries collapse, and what looked like a guaranteed success can suddenly become worthless. Without diversification, a single bad bet can wipe out years of savings and put your financial goals back to zero. Think of diversification as financial insurance. It doesn't eliminate risk, but it spreads it out so no single investment can destroy your future. Imagine putting everything into one stock because it's the next big thing. If that company faces a lawsuit, regulatory changes, or even just a disappointing earnings report, your portfolio could lose half its value overnight. But if you had spread your investments across different stocks, bonds, real estate, and even cash reserves, one bad performance wouldn't sink the entire ship. The beauty of diversification is that it allows you to benefit from different market conditions. For example, when stocks are struggling, bonds often hold steady or rise. Real estate may grow when inflation is high, while certain commodities like gold act as a hedge during uncertainty. By balancing across multiple assets, you reduce volatility and give yourself a smoother, more predictable growth curve. It's not about hitting home runs, it's about consistently getting on base over and over again until wealth compounds in your favor. Many beginner investors skip this step because diversification doesn't feel exciting. It's not glamorous to own an index fund that tracks hundreds of companies instead of betting everything on one hot stock. But here's the truth. Boring often wins in the long run. The people who try to get clever by putting everything in one investment usually end up broke. The people who diversify quietly, patiently, and consistently end up wealthy. So if you're serious about building financial security, spread your bets. Diversify across industries, asset classes, and even geographies. That way, you're not just relying on one source of income or growth, you're building a fortress of wealth that can weather storms, survive crashes, and continue growing no matter what happens in the world. Because at the end of the day, wealth isn't about being right once. It's about staying in the game long enough for your money to grow. One of the most overlooked ways people sabotage their investments is by ignoring the silent killers, fees, taxes, and hidden costs. On the surface, these expenses look small and harmless. A 1% management fee here, a little tax on a sale there, but over time, they can drain a shocking amount of your wealth. The difference between paying attention to these costs and ignoring them is often the difference between retiring comfortably and struggling financially. Let's start with fees. Many investors hand their money over to mutual funds or actively managed accounts without realizing how expensive they are. A 1% or 2% annual fee may not sound like much, but compounding works against you when it comes to costs. For example, if you invest $100,000 and earn an average 8% return for 30 years, you'll end up with about $1 million. But add in just a 2% annual fee, and your ending balance drops to roughly $574,000. That's nearly $500,000 gone, not because of bad investments, but simply because you didn't pay attention to fees. Then there are taxes. Selling investments too frequently or cashing out at the wrong time can trigger unnecessary tax bills that eat into your profits. Short-term capital gains, in particular, are taxed at higher rates than long-term gains. This means that if you're constantly buying and selling, you're not only reducing your compounding potential, you're also handing a bigger portion of your profits to the government. The wealthy understand this game. They structure their portfolios for tax efficiency, holding assets long-term, using retirement accounts strategically, and even harvesting losses to offset gains when necessary. Hidden costs also come in the form of trading fees, fund expense ratios, and even inflation. Every trade you make might seem like just a few dollars in commission, but hundreds of trades per year add up. Expense ratios on funds, if not checked, quietly siphon off your returns year after year. And inflation, though not a direct fee, acts like an invisible tax on your money. If your investments don't outpace inflation, your gains are actually losses in disguise. The lesson is clear. Every dollar you lose to unnecessary fees, taxes, or costs is a dollar that could have been compounding for your future. Paying attention to these details may not feel exciting, but it's one of the smartest moves you can make as an investor. Over decades, the difference is staggering. Build a low-cost, tax-efficient portfolio, and you'll keep far more of the wealth you've worked so hard to grow. When it comes to investing, numbers and strategies matter, but psychology often plays the biggest role in success or failure. The truth is, most people don't lose money in the markets because of bad math. They lose because of fear, greed, and emotional decision making. Letting emotions dictate investments is one of the most costly mistakes you can make, and it's the reason so many people stay stuck in a cycle of buying high and selling low. Think about what happens during a market crash. Headlines scream doom, people panic, and suddenly investors rush to sell their assets at rock bottom prices just to protect themselves. What they're really doing is locking in losses. Then when the market recovers, as it always has historically, they've already exited and missed out on the rebound. On the flip side, when the market is soaring and everyone is talking about how easy it is to get rich, emotions shift to greed. That's when people pile in at inflated prices, buying at the top because they don't want to miss out. Both fear and greed drive people into the exact opposite of smart investing behavior. Emotional investing also shows up in more subtle ways. Maybe you check your portfolio every single day and let small fluctuations influence your mood. One red day and you're convinced the sky is falling. One green day and you feel like a genius. This roller coaster of emotions pushes people into making impulsive trades instead of sticking to a long-term plan. Wealthy investors understand that markets move in cycles and short-term noise means very little compared to long-term trends. Discipline is what separates successful investors from the rest. Having a clear strategy and sticking to it, regardless of headlines or temporary setbacks, is the key to long-term wealth. That means setting rules for yourself, investing regularly, holding quality assets, and resisting the urge to react emotionally to every market swing. Some even automate their investments so they don't have the temptation to time the market. The reality is you'll never fully remove emotions from investing. They're part of being human, but you can control how you respond. Instead of panicking during downturns, see them as opportunities to buy at a discount. Instead of chasing hype during bull runs, remind yourself that trees don't grow to the sky. By keeping emotions in check, you not only protect yourself from costly mistakes, you give your money the time and stability it needs to grow.